As a lot of you know, the website moneypodcast.com.au, if you need to reach out to get a recommendation for a financial advisor or mortgage broker, I'll have a look at the details and introduce you to the most appropriate person that I think can help you out, just to kind of save time and all that. And I do that personally. I've taken the view that I want to know what's out there, who's listening, and just really be on top of that. We had one come through a short time ago, and it was a bit of an inheritance situation that a young woman received indirectly, and we're going to kind of talk about that on the show today, because the more that we kind of get older and all that, and particularly, John, when we started this podcast, we didn't get many inheritance case studies, 7.5 years ago, because our audience maybe was a bit younger, and now with the average age being around 30, 33, 34, things are starting to flow down. So we're going to talk about some case studies today, and the first one being on an inheritance. This podcast is brought to you by Sphere Home Loans. If you want to get a mortgage, Sphere support the show, you can reach out to sphere.com.au. What they basically do, mortgage brokers, there's no fee to you involved. The banks remunerate mortgage brokers. It's the same rate as you'd get with the bank, sometimes cheaper than the bank. They will kind of do all the paperwork on your behalf. They will understand your situation. They will give you options with lenders and tell you the pros and cons of both. And you really will be in good hands with Sphere Home Loans. So just search Sphere Home Loans in the show notes, or search them online, whatever. They're in the show notes, they're online, and thank you for doing what you do, Sphere Home Loans, and supporting the podcast. My name's Glenny J, and you are with...
John Pidgeon.
And this is Money, Money, Money. All right. My ear just started beeping.
Did it?
It did.
It's an alarm in your head.
Yeah, I think I've got to go to the doctor's. I got a thing in my ear. And anyway, TMI to the listeners at home. Hey, so this question came through, John. I'll give everyone a bit of a snapshot with the lay of the land. I've kept it anonymous. She actually said if you use any of this on the show, keep it anonymous. So we'll call her Megan. Mm-hmm. The rest of the details are pretty much the same. I will change the location as well, which it really doesn't matter. Age 30, female from Melbourne. Income is 86 after tax, which, Megan's on a probably north of 100 salary at age 30, so that's awesome. And here is what she said in her own words, because I always like to ask people, in your own words, how can I help? Hello, I'm living in Melbourne and just turned 30, and unfortunately my mum has recently passed away. All assets were left to my father, but he's going to pass on her super to me to supercharge and secure my financial future, effectively. The super fund has about $850K, and it'll be sitting in a pension account for the next 12 months while we figure out how to invest it more effectively. I don't have any children or own a home. Any advice would be much appreciated. I asked, are there any other relevant details? No debt, no kids, 2 dogs, and a boyfriend. The boyfriend, I don't know if he's living with her, but he's 29, recently completed a trade on about $60K. And some other information, she's got about 23 grand in cash savings. She can save about $1,000 a month. She got 40K in her super and a share portfolio with about 4K, and she's invested through the Sharesies app and platform about 18 months ago. No other properties. So that's the situation. How are you plucking this chicken, John?
Yeah, I think the good thing...
and condolences for losing mum.
Absolutely, first and foremost. That's never a great situation to be in, and it's I suppose a positive. It's eventuated out of a horrible negative. The next 12 months, is stress-free for her in terms of the money sitting there in that pension account, isn't it? So it does give her a good time to give her time to be able to decide what the best next steps are, because often people might rush into spending this money quickly. So that's the first part of it that needs to be noted. It's like a lot of, I suppose, 30-year-olds, or not even age-based. It's really, okay, we're finding our way in life where we've got a savings plan, we're building up some super. Now what's our next steps? Is it ETFs? Is it property? Is it putting more money into super? What is it that we want in the financial part of our life? And obviously being a property guy, I'm saying,
here we go. Look out. Where's the break glass for property emergency?
Does Megan want to stay in Melbourne for the next 5 to 10 years? Because if we know it's rigid, so we don't want to go and buy something and live in it if we're not necessarily going to be there for the next 10 years maybe. So having a think about how important that is in her life, and what it means to live in your own home for security, boyfriend aside or not. It's just a thing that people like to tick off. So it doesn't seem as though it's on the agenda. She hasn't mentioned it, but she looks like she's an open book. So that would be probably the first thing that I would look at is, can we use some of it as a deposit on a property that we might want to live in Melbourne, if that's going to be our long-term view and an aim of ours to own a property that we want to live in one day. It's essentially tax-free money that's landed in her lap that she's got the ability to use. Now, that doesn't mean, right, it all goes into property and that's all, because she's then got the ability to keep some in an offset account, flush some through to ETFs, some into super, and do what she wants with it. So have that flexibility. So it's a really, I would think you'd be looking at some sort of balance that says maybe we have a few buckets in our life that some of it's property, some of it's shares, some of it's super. What do you think?
I think there's one big thing that we 100% need to consider here. Whenever we look at people saying, hey, mum and dad can give me money, or we've got an inheritance that landed in dad's lap, mum sadly passed away, he said I can have some of it and all that. So what I want everyone to do, and the thing I like about this situation is we're not doing anything for 12 months.
Yeah.
And I recently did an episode on the Retire Right podcast, and I think it was called How to Really F Up Your Money. And it was a story, a real life story about money going between a parent and a child and all the implications. And if you do it the wrong way, you can't unscramble that egg. A couple of things with this situation, and I have forwarded her to see a financial advisor and get some advice.
Yeah.
That 850 in pension phase, and because we don't know the details, and that's why you need a financial advisor. When you have a pension account, it's still within superannuation. It's just got a tax-free structure. The pension account may have a reversionary pension. So if the person dies, their monthly or weekly pension that was going to the spouse, when that person dies, if it has a reversionary beneficiary set up, it automatically just goes to the spouse's name,
right,
and they receive the money. So assuming that, we need to have a look at some broader implications. Now, I'm also assuming that the father is financially okay.
Yes.
Effectively saying to his daughter, and it sounds like it could be an only child situation, I'm going to be fine. You have 850 of mum's super and potential life insurance while you put that on mute, Johnny. And so the implications are, number one, we need to work out because what's actually happening in this situation, the comments are, mum sadly passed away. Dad said I can have 850 of her super.
Yeah.
what's happening in the real world in black and white, the death is after the fact. Dad's got a superannuation pension now with 850K in it. He wants to gift 850 grand to his daughter. That's what I'm looking at. So we need to make sure whether there are any taxes that need to be paid. Because if you've got a normal super account and you are over the age of 18 as a child, the money paid to you directly on the death of someone, there's a tax portion. But the complexity here is it's technically now in the dad's name. So the money should, in theory, go in. The dad can cash out this whole pension into his bank account, 850. Then he can choose to gift 850 away.
Yep.
Now, the implications that may arise is if the dad is on some type of pension from the age pension or whatever, and he wants to give away $850,000, Centrelink will deem that as an asset because you can only do $30,000 over 5 years. Or if he isn't on age pension and he's going to go on the pension in 2 or 3 years, Centrelink look back 5 years.
Right. So we're not assessing that this 850 is actually 850, or
I think it could be 850 if it is flowing the way I think with the money. It's potentially a reversionary pension in the dad's name. Once you're over, and we just don't know the dad's name, like I will assume he's over 60 or over 65 and stopped working or whatever the reversionary, and I'm just not in the game enough. I know conceptually, but I'm assuming that the money can be withdrawn from the pension account 100% tax-free into the dad's bank account.
Yeah.
So the question is, the dad giving away 850 grand, is it going to cook his situation over the next 5 years?
Yeah. I understood this to have got to the stage where that's already sorted.
No, because she literally said, I'll be sitting in a pension access account for the next 12 months. So the fact that they said it will be sitting in a pension access account means it's probably still just sitting there in pension phase.
Yeah, I know, but in terms of having the conversations as to who pays tax and how it affects Centrelink and all these other things, I'm presuming that that's already been discussed.
No,
but
because she said recently passed away. And
okay. So it's still real early days then.
But that's just a bit of a background. When you're a financial advisor and you see these things, you've got to actually go back and cascade it down to be like, okay, so the money's technically in the dad's super pension now, if it's a reversionary pension. How do we get that out? If we cash it out, we assume there'll be no tax, but we need to check. And then we go, okay, dad's now got an $850,000 asset. If he gave $850 away, is it going to cook him later if in the next 5 years he needs age pension?
Yeah.
So we will now proceed assuming that, as you said, the $850 has landed in her bank account, for example, because you can't just transfer money sitting in a pension account to someone else's super. Like it's got to be, pension's got to make the payment, commute the pension, all that stuff.
Yeah.
So for me, a couple of things here, and we've got to look between the lines, but he's going to pass it on to me to supercharge my financial security for the future. When I see, and this is just total reading between the lines, right? When I see the word boyfriend or girlfriend, sometimes that can mean not a long-term relationship. When I see the word partner, but again, it just depends. Like I talked to my 18-year-old cousin once, 17 even. Oh yeah, my partner. I was like, your partner, give me a break. You just finished high school. It's your boyfriend. So
yeah. So you can put long term in front of that. It means a little bit
so
more.
I'm assuming old mate, maybe they haven't been together for 10 years. They might have been. But I think what we need to do in these discussions is just really make sure that Megan, not her real name, is protected, because if things went south and they'd been living together for 18 months and freaking old mate bro got a sniff of there's, a ton sitting there. I want some of it. We just need to kind of do those things. And I dare say in this relationship and in this era, there's like 50% of people will end in divorce once they get married.
Yeah.
Like it's wild. I'm 100% in this day and age, if you are rocking up at age 30 with we'll call it $1 million, all right? 850, couple of years, it's going to grow $1 million. Literally few grand prenup, don't care. It's mum's inheritance, effectively. We need to protect it.
Yeah, and don't tell too many people that you've got it.
No, I've got a story for you in the after party. Okay. I'm going to write after party.
All right, so just on that point, how would someone in that situation go about protecting that?
Yeah, so first and foremost, a binding financial agreement, aka prenup.
Yep.
We would do that. Another way that you could do it, which, nothing's ever guaranteed in this life, but you just want to have some protections in place. So if things do go sour, there is some protection.
Does a will help in that?
It does, but what I'm kind of thinking, if we cut to the chase and get to the nuts and bolts in this, I'm pretty much saying it's given to you to supercharge your financial future. There is the trade-off with if we bought an $850,000 house with cash, that will supercharge your financial future because guess what? For as long as you're on this planet, you won't have a mortgage repayment.
But you're cash poor.
Not necessarily because you lump sum cash poor, but $1,000 a week that was going to a mortgage or $800 a week, you can put that to invest for the future.
Yeah, correct. But what I'm saying is you're leaving yourself no buffers and everything else.
Like and you'd really want to make sure that, as you said, you want to live in this place.
Yeah, she's what she's saving, $1,000 a month, isn't she? So got a good savings plan by the sounds of it already, which is fantastic. 23 in cash savings now, which you just call a buffer.
Yeah, emergency fund.
And yeah, but even so, like if you might just as an exercise go and talk to a mortgage broker and say, well, hypothetically, how much could I lend on today's salary? Just me.
Yeah.
If that's 400,000, you could then say, well, okay, I could portion, I don't know, 300,000 of this 850 towards that property and buy something at 650 or 700 and live in it, pay no stamp duty. I don't know. Depends on where she wants to live and whatever. But you're just carving it up in a way that's actually going to suit Megan and not suit anyone else out there.
Yeah. So I honestly think there's probably 4 options and maybe a blend of some. The first one, buy the house with cash. On the proviso that we pick a nominal amount, $750, $800 a week, normal rent for equivalent, and we then go, we're going to now salary sacrifice that into super each week.
Yeah.
So you're building your financial future that way. The other thing I'd probably say is I think there's no point, in my opinion, going to buy an investment property with the whole amount. If you did want to buy an investment property, we're putting a deposit down, maybe 20%, carve off, 160 grand of that as a deposit for the investment property, and not because we want to make sure that if we do want to buy a house to live in, we don't have to borrow more money that's non-tax deductible.
Agree.
The other option is potentially to invest it all into shares and ETFs in your own name. Okay? But what we need to look at first, the house decision needs to be worked out before you do any of these options, I believe, and I'll tell you why in a minute. And then the next option would be, and you're not going to get it all in, but put a big chunk of it into super. So she's only so we're recording this in March. I think this comes out first week of April. You would put 100 and, what's the non-concession? I've just had a mind blank. Is it non-concessional 130 now? NCC super cap. 120, sorry. Yeah, just had a. So what you can do, you could put 120 after-tax contribution into her super now, and then in 1st of July, you can bring forward 3 years first. So 3 years. So then she could put another 360 into super. So she could put 480 into super. Done. Financial future taken care of. Put the rest into a house deposit, pay a bit of a mortgage, all's good with the world. But I'm kind of thinking that I would want her to look at potentially, if it is, I want to live in Melbourne for the next few years. I want to buy a house to live in. I'm probably even buying worst house, best suburb type vibe because, and this is why I love these conversations, John, because you've got that $850 to spend on a house. 30's still young.
Very young.
As I'm telling myself. Not that I'm 30.
You got
the
a
whole
tree in
thing
front of
is
it.
we've got a bit of an opportunity here to make a strategic decision to say, yes, we want to live in Melbourne and own the house we live in. Let's try and buy something with that investor hat on as well, because usually we're just buying and it's a lifestyle decision. But because we've got the capital, can we buy something a bit dodgy in a good place and then over the years we maybe renovate it? I don't know.
Yeah, so I think what comes to mind when you're talking about that is their risk profile.
Yeah.
It's like 30, never bought a house before, don't know what the appetite for risk is, but yeah, definitely can think about those things. And there's probably a 1A to your one of buying your own home is...
I just want to jump in.
Yeah.
She's got 2 dogs. She's going to want a house for the yard.
Well, this coincides with my 1A.
Oh, okay, cool.
Sort of, is to say, well, okay, buy your own home, first homeowner concessions, like maybe a stamp duty potentially.
What's that in Melbourne or Victoria, like 657 or something?
I think it's 7 now.
Yeah. So you're saying try and scrape in under that.
Not use it as I must do this,
No.
but definitely like a concession, like an option for someone. And Dad, no doubt, is probably, would be still reeling from the loss.
Everyone would be, yeah.
Am I staying at home? I'm presuming that she's maybe staying at home.
Do
you reckon she's out?
I think they're both. Like, she's on $100,000 a year and 30. We're not living at home at that age, are we?
Oh, well, I hope my kids aren't, but they well and truly could be. Like it's.
I'm assuming they're both renting.
Okay.
Because they can only save They can only save $1,000 a month.
Yeah.
Where's the money going? If you're getting good rent, anyway.
Did they say they're living together?
No, but I've made that assumption.
Yes. Okay. Anyway, it's a 1A to say, can I move back home for a period of time post qualifying if I qualify. If I don't, then I can rent it out or I can rent rooms out. So there's sort of hybrid versions of that home. But yeah, I agree. The ability to go and buy in a good quality suburb with the ability to add value later on is huge, which will, when we're talking supercharging, that's a supercharged version in the property space.
And I think, because I'm trying to think with my statement there, I made that statement and I'm trying to think, did I contradict myself based on other statements I've made in the past?
Happens often.
Yeah, it does. Yeah. When you are buying a house to live in, it is primarily a lifestyle choice, which might not be the best choice if you were buying an investment property, quote unquote.
Yeah.
Like, you've got to buy a house, live in it, I'm enjoying it long term.
Yeah.
I think the carve out, it is different because it's potentially a cash purchase. So you're really not going to be paying interest on the debt. So can you buy something in a more premium place that is a bit of a older, renovated delight and all that stuff?
Yeah.
And because you don't have a mortgage payment, that $1,000 a week of mortgage that you may have paid, you can start to save up and cash flow and renovate that. That's kind of, I don't think I'm contradicting myself.
No,
I mean,
you're not.
All the bros on YouTube will tell me I am, which is fine, but it's just an interesting thing. And the other thing I would say as well, if I'm still okay with, we want to buy a house with cash, okay, I think this would be really important. Let's ask Dad, hey, Dad, what would your expectations be of this gift? It's Mum's super. Is your expectation that I put as much into my super as possible, and we can put, what did I say, 400, 500, 600 grand or whatever?
Yeah.
1, 2, 3, 4, I forget. We can put a chunk into super. I can't put it all into super, Dad. I do want to buy a house. If I did buy a house, it would be in my name. We'll be spending $2,000 on a binding, non-binding financial agreement because. So I think bring Dad on the journey, and this is it. Like, sure, drop $200,000 in the super, drop 150 in, use some, and you'll be able to, with an advisor or yourself, look at the outstanding concessional contributions, so you can put some money in and claim it on tax. So you do that first, then any more you would do as a post-tax contribution, and then, okay, so sweet, we've got 600,000. Okay, we still want to buy a house. All right, well, let's get a little mortgage, $200,000 mortgage. That's okay. We're investing that money into super. Still okay to do that. The thing that's not okay, also do what you want, but the thing that isn't okay is if you said, I want to buy shares with this money, 100% shares, ETFs in my own name. I'll buy a house later on. You need to work out the house situation first, because if you had $850,000 and put in a share portfolio, a year later wanted to buy a house and have a $700,000 mortgage, that debt is non-deductible. But if you bought the $800,000 house and then still wanted to buy shares, the debt's going to be there. Then you would get a second mortgage split on that house and use the borrowed money to invest. So you've got a gearing strategy.
Yeah. And I think I personally wouldn't, unless I've got a spending addiction, I wouldn't be going and paying cash for my property and just leaving myself thin on funds.
Why?
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 Well, because if you want it, it's coming back out as equity.
That's right.
So why not keep a good portion of it? When I want to say good portion, like a third. Just up your sleeve in an offset account. I've got a spending plan going on. I'm not going to touch it. It's sitting there doing its job against my small mortgage. And if I choose to go and buy and put some money into ETFs, so I can do that. I can pivot left or right. And I think the big word with all of this is I've got to have choice, and I don't want to be backed into a corner where I can't get out of.
Yeah, so effectively, I think we both agree that it's just more of a structural thing. And yeah, absolutely.
And she's got 12 months to find out what that structural thing, because she's going to have, and that's the thing about telling too many people, you're going to have a lot of opinions going on.
There's two here that have probably missed the mark because we don't know all the situation. But the whole thing is we agree on the same thing. I'm just saying if you're not sure in the future, just buy a house with cash, get on with your life. Later on, if you want to get a mortgage, do that. But if you say put 20% down, put the rest in the offset, either scenario, we're not paying interest.
No, that's the key. Like just some quick numbers in Vic, like 700, probably max 750. The stamp duty after that gets nasty. So if you're going to spend, 750 is pretty nasty actually, but 700 is a bit more palatable. So if you're going to spend more than that, that's when you just wouldn't worry about the first home, I think.
Yeah, and maybe can you get a premium piece of crap, quote unquote, for 700 and then reno it with 150?
Yeah, and that's the whole risk profile thing is am I comfortable spending 700 in the first place? I'm 30 and I've just woken up with 850 grand. Like, it's a big life-changing event.
And this is the thing online, which I said it in the Facebook the other day. I've said it to someone. It's totally okay if your financial goal and risk profile and all that is to not do anything and pump the mortgage, clear the mortgage, be debt-free on your house. And that's why I really think this strategy, if it was, we just want to own the house, but because it's an inheritance, I need to make a commitment to mum and dad that the mortgage repayment of $700 a week or whatever it is, I'm going to salary sacrifice that into super.
Okay, so on the spot.
You don't have to gear up and invest. You can actually literally focus on paying the mortgage off. When the mortgage is paid off, then we will go and salary sacrifice the super for the next 30 years. Amen.
What would Glenn do now if he's sitting here with that money and no assets up his sleeve?
It'd be the house.
Would you buy it with cash?
Yep.
You would?
Yep.
Yeah.
One and done. Although the house I want around here is probably $2 million, but
so yeah,
I'd end up with the mortgage.
So if you've got the knowledge you've got,
yeah,
but the position is Megan's.
Yeah, I'd honestly buy a house with cash.
Yeah, okay.
And then over the rest of my working life, it then really gives you, she said she doesn't have kids. Are kids on the table? Who knows? If they are, sweet. I can have some maternity leave. There's not as much financial pressure.
No.
In 5 years' time, if I want to go back to work and do all that, we might buy an investment property. We might gear into some shares.
Yeah.
Just at that point, go get a mortgage.
Yeah.
But I think there's a fundamental thing when you own something without a payment or anything hanging off your head, it's amazing. That's why for me, when I buy a car, just pay for it and done. I don't have all the admin of all that. So
that's why there's 1,000 different answers to this.
That's right. So, Megan, thanks for writing in. Apologies that you're going through this. And, take your dad on the journey. Get a binding financial agreement. And we'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
All right, we asked everyone in the Facebook group, what's the wildest, most unexpected money moment you've ever experienced, good or bad? This ties into what I'm telling you in the after party.
Right. So tune in later on. Rebecca had a house fire where we lost absolutely everything and realised we didn't have contents insurance for fire.
So only building insurance.
Well, realised probably means that we didn't check the insurance policy, but she may have
or they
been
were renting and just had contents for theft.
Could have been in a bushfire zone that didn't provide it, but her wording might have been different for that. I don't know.
Yeah, and that's the thing. With fire, it's always going to be total loss because if the fire doesn't burn it, the smoke will wreck it.
Yeah.
If that doesn't have it, the water from the fire brigade will wreck it.
And the, what do you call those things? Sprinklers.
Yeah. Alice. Partner had a catastrophic stroke. Oh, my goodness. We literally read these on the spot. We don't pre-read these. He's now permanently disabled and high needs. Oh, my goodness. We didn't have income protection insurance. I'm now his full-time carer. We have 3 children and we're 5th generation of dairy farmers. Oh, my goodness.
And dairy farming at the minute is not easy work.
That's
that
an unexpected money moment that wasn't good.
Terrible. Feeling for you, Alice. There. Sarah won 2,800 on the lotto a few years ago.
Very nice. High five. Estelle, ex-husband offered me to keep the marital home if I agreed to take on the mortgage of $550K, his business loan $200K, and gave him 100% of my super, $100K plus. Unsurprisingly, it was a no from me. Try the old switcheroo, old razzle-dazzle.
The house must have been worth about $600. Emily, selling my regional house last month for $200,000 more than what I paid to build it only 3 years ago. Big win at 23 years old. Well done, Emily.
Gosh, crushing it. Jazz, going on a TV show and winning $506,000. It was The Block, circa 2020.
Well done, Jazz.
Wow.
Half a brick. That's
tax-free.
It is tax-free. There you go. Hopefully you've still got that 4 years later, 5 years later.
I'm going to see. So I'm just going to Google, like, I wonder, Jazz the Block. Luke and Jasmine. I'm just on Instagram. Yeah. Family travel renos, breast cancer survivor.
Shit.
Amazing. Reality TV contestants, The Block, Brighton 2020.
There you go.
I'm just looking at their little Instagram.
Blue chip Brighton. April says, good that my ex-husband accepted a low cash offer from my lawyer at mediation for separation of assets which were mine prior to meeting him, and he only deducted from as
A meth user. Oh, my freaking gosh.
Wow. Worked out that my stupidity tax for being in a relationship and blind to his toxic ways was less than I thought he'd take. Also good that a block of land I borrowed a deposit to buy increased in value over double between the contract being signed and it getting titled. There you go, untitled land. Sold it due to the soil testing being really shitty, and the quoted foundation excavation cost would have been a small fortune. Up a cool 100K after CGT, though, for doing nothing with it except some admin. So well done, April. Geez, you've been through the ups and downs there, my friend.
Yeah, meth will get you.
It is.
It really will.
Horrific.
Yeah, I'm glad that she got out of there. All right, let's round this off right now. Okay, I got another message, and I think it's from Toby. He wrote in through the website like ages ago, and it was and I forwarded it from the team inbox to my personal inbox, kept it unread, because like one day I'll chat about it on the pod with John.
Right.
It is similar to the first question on the inheritance.
Oh, yes.
And that's why I kind of wanted to tie it in. And it does speak to that point I made before about you can do what you want, just understand the lay of the land. When people say, why are you doing that? You say, because I want to do this and I understand it, so shut your mouth. So that's all good. Hey, Glenny, with a smiley wave, emoticon. We are in a fortunate position to be able to 100% offset our PPOR.
Amazing.
Okay. I would like to keep the funds in the offset and have minimum repayment deducted from the offset. Well, you wouldn't have to. You tell the bank to stop taking payments and then it just...
Either.
Yep. Allowing future access to the funds, e.g. renovations or investments. My partner wants to close out the mortgage altogether and be quote-unquote free. Would be interested to hear your thoughts. Maybe even a discussion topic on the podcast. Well, Toby, we're not discussing this.
No.
So this is the dance, John. You've got a partnership. It is different because Toby and his spouse, they've worked hard to get it. So 100% Toby's partner does have a vote, does have a seat at the table.
Yes.
Like the other situation, boyfriend, yeah, rocked up. My girlfriend's now got freaking $1 million. So I don't know. What's your initial thoughts? And then I'll tell you mine.
It's always in that order.
Oh, okay. Do you want me to go first?
Oh, you go first. Yeah, let's hear it your way.
My thoughts are, Toby, come here, Toby. Talk to me. Look at the camera right here.
Which one?
If you're watching on YouTube, I've turned auto switch off. I'm talking to Toby right here. I would do this. Do what your partner suggests. No. Close the mortgage. Close it off, right? Then, guess what, John? There's this thing in the future, you can always go and get more debt if you want to.
So you're saying get the title back, even though you don't physically get it back these days?
Yeah, get the title back.
Yeah.
We own this. There's no mortgage. And Toby, just live like that for a few months.
Yeah.
If you want to go and get debt to renovate or invest, I mean, actually, I will eat a little bit of my word. The renovation, whatever way we're doing, from now on, in theory, whether we're investing or renovating, we're borrowing money. because we're taking it from the offset, which
Correct.
means interest will start again.
Yes.
So I'm maybe thinking 100% close the bastard, delete it. We don't have a mortgage. Freaking go on a holiday, celebrate. You're probably saving $1,000 a week on mortgage repayments, right? Go on a little cheeky holiday, celebrate. Yay, we don't have a mortgage at all.
Yeah.
Then work out what we want to do with the renovations. If there was $1,000 a week, right, for 2 years, that's $100,000 little renovation and just cash flow stuff. Maybe we do the same thing, close the mortgage and we just salary sacrifice into super. That's what I'd probably do. Close the bastard. You can always go and get debt tomorrow if you want to.
Yeah.
And sometimes, I'm speaking with great experience here, not really. Sometimes it's always better to go at the speed of the slowest soldier.
Yes. Who might get shot?
That's right. So if you are going at the speed of the slowest soldier, this partner maybe is more conservative, maybe just wants to be debt-free and all that.
Yeah.
Mate, you're in a good position. It's not going to kill you. Close the facility, enjoy it. Then as the soldier that's slower starts to understand more, and then we can always ratchet it back up. Because it's really hard, John, to unscramble the eggs if we went full ham, borrowed money, invested, the investments went to crap, partner's a passenger. It's like, I'm not even comfortable with this. What are we doing?
I wasn't from the start. Yeah.
Yeah. What do you think?
Toddy. Is it Todd?
It's Toby, but sure.
Toby. Look at me. So you raised a point that I don't know if you meant to raise it or not, but it's a very important one, is you said do what your partner wants to do. I think that is first part. Sit down and say, well, okay, what are your reasons for doing or thinking that we should make that decision? And these are mine coming from Toby, right? And either way, we're on the same page going forward with the decision that we end up making. So I think that part is critical when there's two in the conversation, Glenn. What would I do? We know we have to do some or want to do some renovations and some investing down the track. So I would probably split down the middle and say, right, I've just used an example here, okay? We've got an 800K property and we've got a 500K debt and we've got 500K that's potentially sitting in the offset or already is.
Yeah.
Yep. Pay down the mortgage by another 250, keep the 250 debt, but also keep 250 in the offset for renovations. Because, as you said, either way, you're going to have to borrow the funds for the renovation.
Unless you're saving and cash flowing it.
Yeah, so you are saving because we've paid 250 down off the mortgage. So we're putting those funds into a separate account to make sure that we can visually see those over the next 3 years. We can get our renovation done when we need to. We'll increase equity in our home because we've paid some of it down. The part of it that says let's get rid of our mortgage and get the title or the deeds back, yes, it's easy to get another loan, but there is a bit more of a paper trail to get that done.
Yeah, and if the situation has changed and someone's taking time off, you might not get that.
You might not get that, and that's
okay.
my next
It wouldn't be
point.
the end of the world.
It wouldn't be, but I'm leading to, again, things in my control. It's like, Toby, with your partner, what's happening? Are we having kids? Is our lending going to become less and less? Do we need to lend?
Do they have kids to start with?
Yeah, so we just need to, I would just hedge the bet, so to speak, and just say, look, bit of both, and we've actually got a win-win here. So,
yeah. All right, well, there you have it. Thanks so much for listening today. Be sure to be kind to others and do all that good stuff out there. Our opinions are what you paid for them, everyone. My name's Glen James, joined by
John Pidgeon.
And this was Money, Money, Money. Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.
So, wildest thing happened. I haven't told you this yet.
Right.
Had a lead come in to the Get Help,
Yep.
and I sent them to a financial advisor who I thought, so the situation was, hey, I'll just, because I'm keeping it anonymous, around 40-ish, got good super, got some money that has come in. I'm like, oh, inheritance. And I'm like, oh, yeah. Oh, it's a lot. Oh, yeah, it must be a typo or whatever. So sent it to an advisor. They got on and say, hey, if you want to talk to us this afternoon, like literally let us know. And they talked this afternoon, and I saw that reply and I'm like, that's interesting. It must not have been a typo. And I've only done this twice, actually 3 times. One, someone wrote in and there was like going through cancer, like terminal prognosis. I said, hey, if you want to jump on the phone, like I'll do what I can. Another time was a complex retirement thing. And then this time I said, hey, I don't usually do this, but if you want to just give me a chat as a third party, happy to have a chat. They won a Powerball, $30 million.
Wow.
I thought the 30, and I thought, oh, is it a type? Is it 3 million? Oh, and I sent them to an advisor that could handle 3 million or 30 million. And I'm like, no, I don't know if it would be a typo because they've literally put 30,000,000. Anyway, so I got on the phone to them the other day, and she's listened to the podcast for years.
Wow.
They
no longer needs to listen.
No longer, mate. This is literally, and it was just an interesting, fun discussion.
Wow.
They're like, look, the right type of people. Like, look, we really don't want for anything. Like, we don't know what to do. And I talked to them about things to kind of look out for.
Yeah.
I said, look, people may come out of the woodwork.
Yeah.
They're not really going to tell extended family.
Yeah.
They do want to help their siblings, and one of side of the family they're literally not helping because I think there's been some craziness and all that. If they got a sniff, it would just be and so basically at the time of recording they probably have received the money in their account.
Jeez.
And they're not going to do anything for a good 6 months. As soon as the money hits the account, they're actually going to resign. They weren't in professional like accounting or lawyer type roles, but there was a good household income.
Okay.
I think they had $400,000 left on their mortgage.
You're right. Capital city. Like
Yeah. And they're like, yeah, we don't. She even said, oh, literally I was fueling up the other day and I'm like, oh, I still put the cheap E10 in because I'm like, and so I'm like, yeah, and this is the psychology you're going to have to work through.
Yeah.
And like I said to them, you just broadly give some, save some, spend some.
Yeah.
They want to do a bit of charitable stuff and potentially a charitable trust and all that. And I said, guys, even while the money's just sitting on a Macquarie CMA or whatever for 12 months, money's not your problem anymore.
Nah.
You guys need to work out what you're going to do for the rest of your life. And she's like, oh, I'm interested in this thing and I want to do that. I'm like, awesome. And he's like, oh, I don't know. Yeah. I'm like, okay, what did you like doing when you were a teenager? Like, we need, I've seen too many people come into money and it wrecks their life.
Yeah.
And
no longer a drive for something is the
No.
purpose.
so, and I said to them, they're like, oh, yeah, we're thinking about maybe going to Fiji for a week to just celebrate. I'm like,
Go for a month.
one, it's the Maldives.
Yeah.
2, it's a month.
Yeah.
And 3, it's business class.
Yeah.
And I said to them, if you blew $100,000, and I'm good at spending other people's money, but I just wanted to give them context.
And yours.
And mine. Really great at spending mine. If you blew $100,000
No
over the next 12 months and you did some traveling, doesn't move the needle.
No dent whatsoever.
I said, the problem you have, and I've actually got to email them this afternoon. I said that I'd recommend some books. I said, you've got to read the book, The Millionaire Next Door, Because I said, the problem you'll get if you get on that slippery slope, and it's like, I need that Gucci bag, it's $5,000, and they're not those people. Absolutely not those people. And I said, tomorrow when the money arrives, clear the mortgage. They're thinking about helping one of the sisters out or whatever, not telling them, but saying, hey, we've got someone we know has a rental property that they can rent it to you for like a quarter of the price. And they buy it through a trust and have a real estate manager so that they don't know. So they're being smart with it.
Do you reckon you can become one of those people though?
What we find when you come into wealth suddenly, it just amplifies your personality.
Yeah.
If you're an absolute cockhead with money, guess what?
Yeah.
Andrew Tate comes to mind. Some of those rich, smug tennis players come to mind. It amplifies who you are.
Yeah.
But if you're, and she's like, I'm so glad that I put the work in with my spending and we're really good. I don't think it's going to wreck these people.
Yeah,
and
they got the foundations.
But I said to them, I'm like, yeah, the day after that money's in your account, the mortgage is paid off. Sure, go and buy 2 cars, $50,000 each, if you want or need. Like, it's just,
it's exciting.
it's not moving the needle.
No.
And I said to them, like, look, I'm happy to be a sounding board. I'm referring them to another advisor. They've talked to another. Did you listen to the episode I did with Woodbury Private about managing money for high net worth people?
No, I saw the marketing on it.
Yeah, so I'm going to introduce them to the team at Woodbury,
Yeah.
going to introduce them to some other advisors who I know and trust, and they've spoken to a private bank. And I said, the thing is, the principles that apply to if I had $500,000 or 30 mil, they're pretty similar. We're not doing anything that's high pressure and urgent.
Yeah.
We're just doing this at our speed.
Yeah.
If we don't vibe you, and if we don't think we're a vibe, we're not doing it.
Yeah. Yeah, you can really get a good team of people
And
around
then-
you and make some key
And realistically, you know, I'll send this to them as well. Like, it comes down to, okay, so what are we going to do? Sure, buy that $3 million house.
decisions. Yeah, you throw a couple of properties in there.
Well, and I said to them, like, I think I said, that's what I'm going to say now. It's like, if you wanted to build a little property portfolio, get someone like John, just tell him he's $5 million or whatever. Can you get us a little, 5 properties or go to a commercial one but within that, they're going to get the advice, say, okay, if you do it, it's going to be through this structure and all that.
Right.
So,
yeah.
did that guy ever get back to you, my ex-client, who literally had, I think, 5 or 10 million in cash that he wanted to? They're just too busy. That's the problem when you're big business owners like that.
And the ones that I work with that are in this sort of ballpark, it's like they're big business owners and hard to get hold of them when every phone call, every communication is appreciated because it's few and far between. But it's reoccurring, like year on year, there's continual income, whereas this is a finite amount at the minute. So it needs to be thought about a little bit differently.
Yeah, but as I said, if they wanted to buy a nice premium house, spend $3 million,
Great.
buy a couple of reasonable. We can't get into that. We're buying a Maserati. You can, but it can be a slippery slope.
Yeah.
But the same thing, I said to them, what you need to do, you actually need to still work backwards and say, without a mortgage, with some money that we're comfortable with, and I want to pursue this hobby or thing. Okay, this is what it costs to wake up for the morning. We want 50 grand a year just for holidaying.
Yep.
We want 50 grand a year for hobbies. And we want 50 grand a year that we can give away to charitable causes.
Yeah.
That amount could be 350, 500. That amount could be 350 to 500 grand a year. Okay, that's your target. You're just not spending more than that amount.
No.
You'll be able to, but...
You got a cap on things, haven't you?
Yeah, so...
Yeah, good story.
All right, bye.